Welcome back to Ownership by Ritholtz. I'm Nick Sapienza. Today we're answering an important question when it comes to preparing for retirement. What happens if you retire at a bad time? Say a bear market or a period where stocks offer little to no growth. In this episode, I'll show you how to protect your portfolio and your lifestyle in retirement from this specific risk. And to do that, we'll walk through a real case. We'll compare 3 strategies side by side and teach you how to build a plan that's durable enough to withstand the toughest environments. First, let's talk about what this risk is and how it happens. What we're talking about today is sequence risk. It's the risk of withdrawing from your portfolio during a period of losses or low returns where it causes permanent damage to your portfolio if you're not prepared for it. So this could happen during a lengthy bear market like the dot-com bubble or 2008, or even worse, a lengthier period, say a 10-plus year period of low returns where stocks grow less than the overall rate of inflation. When this happens, we call it a secular bear market. There have been about 4 secular bear markets since 1900, with the most recent being from 2000 to 2013. The good news is that they're always followed by secular bull markets, but we have to survive one to be able to enjoy the other. Now, let me introduce you to Steve and Maria. Steve and Maria are in their early 60s. They're healthy, active, and finally ready to enjoy the life they've worked so hard to build. They've saved about $2.6 million. They have no debt. And their goal is pretty simple. They want to spend $130,000 per year. They want to travel and enjoy themselves while they're still young enough to do so. But here's the challenge. The portfolio that got them here won't be the one that gets them through the next phase. And here's why. They're still holding a large position in a single stock. It's Steve's former employer. It's been a strong performer for years, and they're reluctant to sell. They both know that logically they need to diversify, but here's where that fear bubbles up. Every time they think about selling, they question themselves. What if we sell our best asset and end up with something worse? The last few years, the stocks offered big returns, and they've been a blessing in some ways and a curse in others. And that's until you step back and realize that the reason that you got those returns in the first place was because you took on so much risk, and it could have just as easily gone in the other direction. They've also talked about putting the proceeds, all or most of the proceeds, into an S&P 500 index fund. It feels diversified, it's familiar, and it's had a strong run, but there's also another option. A diversified portfolio with stocks, bonds, and a cash buffer. This means less upside in good years, but more protection in bad ones. You give up home runs and strikeouts for base hits. It's less feast or famine for more stability. To Steve and Maria, that sounds safer, but it also feels like they're giving something up. So the question is, how do we keep growing while protecting the life that we want to live? So let's look at our options and what they mean for Steve and Maria's future. What happens if they stay concentrated in that one stock? What it might look like to shift everything to the S&P 500, and what their future could look like with a globally diversified portfolio and cash buffer. And most importantly, are they really sacrificing more with a more stable approach, or does that added stability create the freedom that they sought in the first place? So each of these paths have trade-offs, but what's really at stake? That's what we want to find out. In scenario 1, their current dilemma, keeping money in the company stock that got them to where they are, this is something that's worked for years. The returns have been great. And honestly, to some extent, it feels like the reason they were able to retire early at all. So why change it? Mainly because there's a difference between a portfolio and a retirement strategy. When you're concentrated in one stock, even a great one, your whole future depends on one story. One company, one set of earnings, one narrative. Now that might be okay while you're still working and adding to the portfolio, but in retirement, the game changes. You're not contributing anymore, you're withdrawing. And that's when concentration multiplies your risk. So let's see what this actually means in practice. If we take a look at this chart, the dark bars show a retirement plan that's built around one stock, high risk, lots of ups and downs, and in this case, we're withdrawing $200,000 per year. The lighter bars show a balanced, diversified portfolio. It's less dramatic and more stable. Look at how much harder that single stock portfolio has to work, how much higher the returns need to be just to meet the same goal. And it doesn't just feel riskier. Because of those swings, you need more money to safely withdraw the same amount each year. On the other hand, a stable, balanced portfolio doesn't need as much growth because it has fewer dramatic ups and downs. So the point here is that more volatility equals more sequence risk equals higher depletion risk. And what that means in simple terms is that a portfolio built around one stock either needs a much bigger cushion, i.e. a lot more money, or unrealistically high returns every year. For Steve and Maria with their single stock portfolio, they aren't just facing emotional stress, they also face a harder financial reality. They would either need a lot more money in their portfolio, or for that portfolio to deliver exceptionally high returns year after year, or the ability to drop their spending significantly. And that's a risky bet, especially for someone in retirement. Now, some of you might be thinking, what if I miss out on the next Nvidia? This is a fair question. Nvidia is up over 1,500% over the last 5 years. If you put $100,000 into the stock in 2019, you'd have more than $1.5 million today. But here's what that story leaves out. Along with its massive growth came massive drawdowns. It dropped over 60% in 2022 while the S&P fell by 25%. And it took over 18 months to recover. Now imagine that you're retired and withdrawing money. Would you have held? Would you have done something drastic? Would you have sold out of fear? But here's what I'm not saying. You don't need to make an all or nothing decision. The thing about concentration and sequence risk is that if you have enough money, you can afford to take on more risk. But we want to strike a balance between upside and safety. So how do we do this? We do it by sizing our risk appropriately. For most people, that means keeping no more than 5% or even 10% of a single position in their portfolio. And here's a way to test this. Remove that 5 or 10% from your portfolio and rerun your plan. Recalculate your withdrawal rate. If it's still in a safe range, you're probably okay. For Steve and Maria, it only increased their withdrawal rate by about 0.5% per year, which is still a comfortable place for them to be. Now, before going through this process, they felt very reluctant to make changes. But after seeing the numbers and understanding the risks and finding a smart way to make room for both, they felt like a weight lifted off their shoulders. They realized they weren't giving up on growth, and instead they were gaining a plan that they could actually depend on. Now, let's break down their second option where they consider selling their stock and putting all or most of the money into an S&P 500 index fund. At first glance, this feels like a big improvement, and it is. It's diversified, 500 companies, low cost, and easy to understand, and has performed really well over the last 10 to 15 years. So for a long time, this worked, but let's see what happens when it doesn't. From 2000 to 2013, the S&P 500 returned almost nothing after inflation. Remember, this is what we defined earlier as a secular bear market. That's 13 years to go almost nowhere. Plenty of volatility, a couple of major drawdowns, but very little progress. Now imagine retiring at the start of that window and you're pulling out 4 or 5% per year to fund your lifestyle, yet your portfolio is going nowhere. That's the essence of sequence risk, the risk that too much damage is done in the bad years for those impending good years to make up for it. And without other levers to pull, other options to draw from in the portfolio, there's no buffer. Every withdrawal chips away at principal, and just like with the concentrated stock, it becomes harder to catch up, even if eventually the market recovers. With this portfolio, we're essentially making 3 pretty massive bets. That the US will continue to outperform, that tech will continue to dominate, and that recent winners will keep winning. Sometimes these bets pay off spectacularly, and we might all believe that they will continue to do so, but sometimes they don't, and that's what we need to plan for. So the S&P 500 isn't a complete portfolio. It's a concentrated bet on one thing, US large cap growth, with a quarter of the index and just a few tech giants. It's not spread across geographies or styles, so it's less risky than a single stock portfolio by a long shot, but still exposes them to significant risks when it comes to planning for income. Now let's look at their third and final path, a diversified portfolio, US and international stocks, high quality bonds, and a cash buffer set aside for near-term spending. On a performance chart, it's not flashy, doesn't shoot the lights out, but it's not built to win the race, it's built to finish it. On the other hand, that's somewhat relative to their starting point. If we looked at that same portfolio over the same time period of 2000 to 2013, the S&P 500 averaged 3.9% per year, whereas a 60-40 averaged about 5% per year. Now, yes, caveat is that this is cherry picking, but the point is to be aware that the best performing strategies can underperform for long periods of time. Everything is cyclical, and everything in your portfolio will disappoint you at some point along the way. So it's not a matter of if, but when this is going to happen. For this portfolio, the returns might be lower than what they're used to in strong years, but that's not the point. This strategy prioritizes durability over excitement. It's designed to stay steady even when the market doesn't, to avoid letting short-term swings derail their long-term plans. So true diversification means spreading your money across geography, asset classes, time horizons. And for time horizons, we use 3 buckets. A cash bucket where we keep about a year's worth of spending needs. In the next 2 to 5 years of spending, we keep in the bond portion, and the rest goes into stocks. For Steve and Maria, this meant 5% in a cash buffer, 30% in high-quality bonds, and the remaining 65% in a diversified stock portfolio. Now, they're also using a dynamic withdrawal strategy, which means that we adjust their withdrawals based on how the market's doing. But it's not just about taking out more or less. We can also switch up where the money's coming from depending on what makes the most sense. Let's look at this back-tested example created by our team members, Kevin and Sean. In both scenarios, we started with $2.6 million 20 years ago in a 60-40 portfolio and withdrew $130,000 per year. But if we switch where we withdraw from based on the market's performance, it gets interesting. In strategy A, the blue line, we withdraw from bonds if the S&P 500 is down year to date, or pro rata if it's not. And in strategy B, the red line, we withdraw from the portfolio proportionately across stocks and bonds at all times, no matter what the market is doing. So in both scenarios, we normally withdraw from the portfolio pro rata. Unless the market is down year to date, then we switch from drawing pro rata across stocks and bonds to bonds only. With our dynamic approach, we would have had a cumulative return of 327%, an annualized return of 7.16% per year, and an ending balance of $9.6 million. And that's after withdrawing a total of $2.6 million over that period. Now, with the static approach, we had a cumulative return of 277%, an annualized return of 6.5%, and an ending balance of $8.5 million. So by being more proactive with our withdrawals, we would have seen a 50% increase or $1.1 million in added value. Now, of course, those numbers will shift if you adjust your withdrawals, either increasing them to keep up with inflation or dialing them back as life slows down, but the point still stands. That's real alpha without the risk, and this is the kind of proactive relationship that all clients want to have with their advisor. So their portfolio is more like a Volvo than a Ferrari. It's not flashy, but it's functional, especially in the first few years of retirement when the stakes are the highest. This is a setup that doesn't rely on one company or one country. It spreads the risk. During a low or flat return stretch, they might not see the biggest gains, but they aren't forced to sell at the worst times either. And that's where the real value shows up. It's not just in performance, but it's in flexibility. With this structure, they can adjust gradually, stay invested through tough markets without panicking, and keep spending without doing all the guesswork. And here's what Steve and Maria gained in return: peace of mind, confidence in their spending, the ability to enjoy their life without watching every tick in the market. That's the trade-off. Now, on the other side of this is a twist that no one really talks about. Sequence risk cuts both ways. Yes, bad timing early on can be devastating, but good timing with the right plan, and you might end up with far more than you started with. Michael Kitces points this out in a 2019 article. When you follow something like the 4% rule, you're just as likely to end retirement with 6 times your starting balance as you are to run out of money. So the takeaway here is that the biggest risk isn't just running out, it's also underspending and leaving millions behind. That's why smart retirement plans and advisors today aren't just safe, they're adaptive. They use strategies like guardrails that automatically scale their spending up or down depending on growth, or ratcheting where they may permanently increase their withdrawals if their wealth grows significantly. And this is how you protect your lifestyle without missing the upside, because at the end of the day, retirement isn't just about survival. It's about building a plan that lets you live, not hoard. And if the market gives you a tailwind, well, you ought to have a strategy in place to enjoy that. Here's what Steve and Maria realized. They weren't trying to get the highest returns. They were trying to protect the life they'd spent decades building. And to do that, they needed to focus on durability. They needed a strategy they could trust, especially when the market didn't meet expectations. Because retirement isn't a one-time decision. It's a series of moments. When the market drops and you wonder if you should cut back, when inflation jumps and you're weighing whether or not to cancel a trip, or when you're tempted to move to cash out of fear. And in those moments, the key question isn't, what's the highest return I could possibly get? It's, am I going to be okay? Do I have a process that I can lean on, one that tells me what to do next? For retirement, freedom isn't just about what you can spend. It's about not having to worry about that in the first place. And that's what a resilient plan gives you, not just protection, but peace of mind. Now let's bring this home. Sequence risk isn't just about something you can predict, but it's something that you can plan for. And here's a quick checklist to help you build a retirement that lasts. First, a bucketing strategy, where we have cash, bonds, and stocks. The ability to stay flexible, use guardrails to increase spending over time as the plan unfolds. Delay guaranteed income. In most cases, it's worth it to delay Social Security for long-term stability. Stress test your plan to see what it looks like through a rough stretch. And if you can, and if you need to, feel like it's necessary, make room for both. The diversified approach and the riskier bets. The goal here isn't to maximize return, it's to minimize regret. And one more thought. People love to quote Warren Buffett, but one of the most underrated things he said is that the most important quality for an investor is temperament, not intellect. So why do we keep chasing the highest return when the real challenge is sticking with the plan to begin with? We don't just see this in investing, it happens in all different facets of life. We say we want peace of mind, then we build a portfolio or a plan full of behavioral landmines. So if behavior is the real edge, then the best portfolio is the one that we can live with through good times and bad. And that's what Steve and Maria realized. They didn't choose the most exciting strategy, they chose the one that gave them the most confidence. They focused on durability and resilience over performance. They prioritized process over outcome. Shifting their portfolio was easy. It was a shift in their mindset and their perspective that was the challenge. So if you're approaching retirement or already in it, you probably have the same questions as Steve and Maria. If that's where you are, if you have the same questions, subscribe, follow along, keep asking the hard questions. We'll keep walking through them right here on Ownership. Thanks again for watching. I'm Nick Sapienza.